company's balance sheet is one of the key reports that investors will use during fundamental analysis. It's a snapshot of the financial health of the business, like how able it is to pay its debts and grow. And it's also the basis of many useful financial ratios that can help investors value a stock. Despite all this, you might be feeling a little hesitation about diving in. And I get it. A balance sheet can be an intimidating piece of accounting at first glance. But what if I told you that you might already be familiar with how to read one? Think about the bank statement you receive each month. It outlines the money coming in and out of your account, your debits and credits, which adds up to its total value. Well, you can think of a balance sheet in much the same way. It details a company's assets, liabilities, and shareholders' equity at the time of reporting. It's structured according to a single key equation. Assets equal liabilities plus equity. Just like your bank statement, these two sides must balance at the end. That's because each asset is derived from some combination of liabilities and shareholders' equity. If the balance sheet doesn't balance, then there's something off about the calculations. Feeling a little more at ease about this whole balance sheet thing? Good. Then let's break it down using our fictitious chocolate making company from earlier in this course as our guide. We'll start off with the left side of the ledger. Assets. Assets are categorized as either current or non-current. Current assets are short-term in nature. Items like cash and cash equivalents, inventory and accounts receivable, or sales still on credit that have yet to be paid. Non-current assets, on the other hand, are long-term in nature. They could be tangible assets like real estate or equipment, or intangible ones like patents, licenses, and branding. Now to the other side of the ledger for liabilities and shareholders' equity. Liabilities are also classified as current or non-current. Current ones are items like debts due within a year and accounts payable, or purchases the company made on credit that it still needs to pay. Non-current liabilities are long-term bonds the company has issued, as well as long-term debt it holds. As for shareholders' equity, it's generally separated into share capital and retained earnings. Share capital is the value of the money that shareholders have invested in the company. So, if our chocolate maker raises $30,000 from investors, it gains an asset of $30,000 in cash. But it must account for it as $30,000 in share capital. Eventually, those investors will need to be paid back after all. Retained earnings are the amount of net income or profits the company decides to keep rather than pay out to investors. The company may want to keep that money aside for a rainy day or for a larger use down the line. All right, so now you understand how to read a balance sheet. But what can you learn by looking at it? For one, you can see how much financial risk the company is assuming. For example, if it has more current assets than it does current liabilities, then you know the firm has money to cover its immediate obligations. If not, all those debt payments could erode its profit over time. Our chocolate maker is doing just fine since it has much more in current assets than current liabilities. And two, a balance sheet can hint at how effectively a company uses its money. For instance, if a company has too much cash sitting around, it might be missing opportunities to grow the business. When our chocolate maker has a sizable amount of cash on hand, it's enough to pay all its liabilities. So, maybe it's time to consider expanding the business by opening up a new storefront. Now, there are many more insights we could touch on, too many to detail here. So make sure to investigate further with your newfound knowledge of the balance sheet. A good place to start is our lesson on valuation matrix. Make sure to check it out.